Sticking with the markets here, institutional investors often rely on trading algorithms, which tend to match and may intensify market swings, but individuals may not have access to algorithms and can easily get caught up in some violent waves of trading. So right now, let's talk about how retail investors can benefit in these volatile markets. Joining us now is Steve Sosnick, chief strategist at Interactive Brokers. He's the head trader at Timber Hill, the firm's trading division. It's easy to get overwhelmed by some of the big players, I think, and worry that you can't compete. But if you know what they're doing, it's even harder for the elephants to move around nimbly, isn't it? Isn't it possible for individuals, if they can figure it out, to benefit?
The mice don't always get trampled in the savannah, right? So
right.
There are ways to go around it. Basically, I think there's a lot of confusion around algorithms. You hear it all the time. The machines are doing this. The machines are doing that. The machines at this point, let's be real, are doing pretty much everything for everybody because the era of the high touch sales trader and position trader they're fewer and farther between, except for more specific trades. But what that means for retail is, if there is a herd mentality, that's your chance to be counter to the herd.
Right.
And that's the opportunity. So what you want to look for is when there's a very high, when you see stocks sell off, they do it in a very highly correlated manner. That's usually a tip that there's some sort of program trading, get me out trading of that nature. That's the time where you want to look for your spots and say, okay, here's where I'm. Don't want to necessarily get in the way of the freight train, but when that train stops, there's my opportunity.
Look, what are the data points that are most important for the algorithms right now? Is it the 10-year? Is it the 2-year? Is it the bond market? It's everything?
Yes. It's a short answer is yes. Basically, if you can dream of an algorithm, if you can dream of a trading relationship, you can turn that into an algorithm. That's really what it comes down to. And so what happens is there are certain algorithms that look for correlations. The 10-year, the 10-year bond moves in a certain way, so we see a correlation with the S&P. That's why there's certain, and you see it go from time to time, especially in the mornings. The yen is up this week, and we seem to follow the yen, and there are people looking for the short-term trading.
At home saying, "Oh, I see the yen," and then calling their broker. It happens automatically.
It happens automatically, and what will happen is, in these things like everything else, they work until they stop, and then then they'll move on and find whatever the latest. We call it a lead in the business.
Are they scalping pennies, or how long are they in these things?
It really depends. You can set up algos that are scalping pennies, and I mean all the high frequency trading is done. It has to be done by algorithms because you can't place orders that quickly. But if you're going to be doing it, you can set up algorithms that you could set up long-term statistical arbitrages, and so it's everywhere in between. It's microseconds to months.
Months. Wow.
Yeah.
So when these algos, because there's always a talk about hedge funds using algos, institution using algos. Mm-hmm. Over the years, has that kind of moved one side to another, and are they all kind of doing the same algos together? Because if one program is doing it, then the other one copies it.
Yeah, there's not that many ways to skin the cat, and also to a certain extent, these are outsourced. I mean, our platform. There's a number of algorithmic trading tools that you could use on our platform that retail uses, and this isn't meant as a commercial. This is just meant as these are accessible to retail investors and small institutions alike. And so what happens is, yes, the bigger the institution, the more sophisticated the algorithm, particularly the ones that are truly quant-driven. But there are all sorts of algorithmic type of trading available to all sorts of investors.
You said, though, it works until it doesn't. I mean, can you get pretty badly burned if you're just riding along and doing these sort of brainless trades?
Absolutely. Yeah. That's the problem is, if particularly the algorithms that sort of follow a trend or that follow what I'll call a lead, mm-hmm. Those have they end badly.
Let's point to an example, right?
Yeah.
A couple of weeks ago, we were trading tick for tick with where the Chinese currency was.
Absolutely.
And if it was above 7, weaker than 7,
yep.
The stock market backed away.
Yeah.
We're now well above 7, and the market's kind of sideways.
Yeah. Good.
And the yield curve right now, I mean, who knows? We could sort of essentially get used to that, so to speak, and all of a sudden it's no longer an edge.
And remember, there are people involved. So what will happen is there are, algorithms are a tool. They're not always all self-directed. So what will happen is you have portfolio managers saying, somebody's got to tell the algorithm what to do. You've got to set a strategy. So what will happen is, you might have something that says, all right, let's sell the market as every time the renminbi ticks over 7, but then that trade runs out of ammunition, and that's how these things end and move on, or something else in the news flow takes over and people decide to focus on something else.
If you just look at the S&P at the end of each year and what happened in between that, and it's just a lot of sound and fury. But you got to try to you got to generate alpha, right, and try to, or beta or whatever, and alpha, and then you got to try, right, and you can do it that way in a flat market. You can make money in a flat year.
Well, that's really the thing. It's a way to profit from the churning. I mean, we're all here every day.
What can individual investors take away from what you told us today?
What individual investors can take away is you can sort of, if you're an astute market watcher, you can see where the big trends are going, and you can choose to do one of two things. You can either follow the trends, which tends to work very well, again, until it doesn't, or you can be a counter-trend trader and say, these guys are all doing one thing. I'm going to zag when they're going to zig. And, I've got a little more, if they're all trading off, if they seem to be trading off of microseconds, I'm going to trade off of days.
Right.
And that's your way to profit from that overreaction in the short term.
Okay, Steve. Thanks. I think I get that. So you either go with them or against them. Sometimes you make money, sometimes you won't.
Sometimes you'll get crushed.
Yeah.
Yeah.